Welcome everybody to the webinar. My name is George Golub. I am Vice President at SDIRA Wealth, and I'm joined by Bernard Royce of ReSure Financial and 401k checkbook.com. I'm super excited about the webinar this evening. Actually, we've got a great topic that we're covering. It's something that I think many of you are already familiar with or have heard of, self-directed IRAs. So we're going to talk a little bit about a wide variety of topics on self-directed IRAs, investments in real estate. A little bit later in the presentation, I'll be talking about the SDIRA Wealth Solution, as well as the advantages of real estate inside of retirement accounts, how to leverage your self-directed plan, long-term potential of real estate within self-directed IRAs as well. So I'm super excited about the turnout as well. It seems like we've got a great audience on the webinar here, so I'm sure everybody will enjoy it. And please stay till the end because we will be doing a Q&A at the end of the webinar. So please type in any questions you may have throughout the presentation in the chat feature on the webinar, and Bernard and I will be answering questions at the end. So without further ado, I'll introduce Bernard Royce, and he's going to be talking about Self-Direction 101, how to set yourself up for a great retirement. Take it away, Bernard.
Good evening, everybody. I'm Bernard Royce, a CPA and founder of ReSure Financial. Thank you for joining myself and George for tonight's webinar. We're going to discuss self-directed IRAs and 401ks. What I'm going to address is the tax side of things, the tax vehicles, IRAs and 401ks. George will be focusing on the actual investment sides, the kind of investments and the particular offering that SDIRA Wealth has for self-directed IRAs. Just a brief disclaimer, both on behalf of myself as a CPA and on behalf of SDIRA Wealth. Of course, anything in this webinar is intended for education purposes only. You should seek competent advice, tax, legal, investment, or otherwise to figure out how this would pertain to your unique scenario. This next slide has a little bit of information about ReSure Financial, which I don't want to dwell upon, but I do want to use this to provide a little bit of context for any discussion about self-directed plans. Self-directed plans are certainly legal, but the vast majority of Americans have not heard of these plans or unfamiliar with them or have lots of questions about them. They're not commonplace. Within the retirement account industry that has well over $20 trillion in it, self-directed accounts still account for only between $50 to $100 billion. And the reason for that, as I've discovered as a CPA and a financial professional, is all about incentives. Most people have IRAs or 401ks either because their CPA recommended it, because it'll improve their tax return, alternatively because a financial advisor recommended it, that they have an IRA or 401k, and in this way the financial advisor has captive funds that he can use either to sell you stocks and mutual funds or have assets under management. Within the self-directed space, there are no asset under management fees on the investment side, so there's very little incentive for anybody to bring these to your attention. But be assured that these are legal, and these are the investments that you can pursue from a legal perspective are definitely things that you should strongly consider for your retirement accounts. Well, what is a self-directed IRA or 401k? Well, self-directed in this context just means that you have far greater or even total flexibility with regard to the selection of your investments. If you set up an IRA or 401k through any of the large brokerages, be it Schwab, Fidelity, Vanguard, all wonderful companies, they will refer to those as self-directed. But they are not truly self-directed because they're going to restrict you to the investments that are available on their platform. When you have an IRA account through Schwab, you can only invest in the securities that are available on their platform through which they generate various fees. So when we say self-directed here, we mean that you can direct the funds to any asset class of your choice with a particular focus on alternative assets. And those are the assets that are not available in a traditional brokerage account. But of course, within a self-directed IRA, you can hold both traditional assets and alternative assets, and they are governed by the same tax code as any other IRA. It's from the tax code perspective, there is nothing unique about these. It's really just about who your partners are. Who are you working with to administer your IRA or 401k and provide the investments? But from a tax code, it's all the same rules that we're accustomed to now for IRAs and 401ks in terms of contributions, tax deductions. It's all the same. Now, why would you choose to self-direct your IRA or 401k? Why would you set yourself up in a way with an account that allows you to direct your IRA to real estate investments? Well, the reason for those are within the stock market, we do know that trying to pick stock picking, market timing are in general not a winning proposition. There's really very little value that any investor and the vast overwhelming majority of investors can add to a stock portfolio. Whereas in alternative space, markets are less efficient and there are opportunities that you can capitalize on that will allow you to get far higher returns potentially with much lower risk. Of course, with total control, people can make decisions that are not wise, but it's under your direction, under your control, and you can maximize on relationships, opportunities, local opportunities, or various investments that you're privy to. And from any financial approach should require diversification. Being exposed strictly to the stock market, even in a well-diversified portfolio, is not true diversification. Various asset classes behave differently under different market conditions. When the stock market goes down, there are other asset classes that go up. So if you're want to truly diversify away your risk, you have to invest in multiple asset classes, which are not related to one another. So that being said, what are the investments and assets that are allowed and not allowed to retirement accounts? Well, the tax code says very, very little about what investments are or aren't allowed. In section 408M of the tax code, this allows collectibles for IRAs and 401ks, and collectibles include artwork, rugs and antiques, most metals and gems, stamps, and most coins, alcoholic beverages. So you can see these are highly speculative investments. And an additional limitation is life insurance are not allowed for IRAs. So if this is a list of investments and assets that are not allowed, well, what investments are allowed? Is there a list for that? Well, there is in fact no list. Nowhere does the tax code, Congress, or the IRS tell you what assets are permissible for your IRA or 401k. There's just that very short list of assets that are disallowed, those collectibles and life insurance. Beyond that, everything is permitted. If it's not on the list of non-permitted investments, then it's fair game for your IRA. If you can imagine it, you can invest in it. And this is very logical. Congress, exists within the tax code. Congress is always looking to remain economically neutral. Congress is not looking to be an investment advisor. Congress is just giving you the incentive to save for the future, to save for retirement using these tax sheltered vehicles. And with those incentives in mind, Congress is confident that we're going to make the wisest choices and the wisest decisions that we can make for ourselves. But Congress is not looking to interfere with our investment choices. To give us some idea of what the differences are between a regular IRA and a self-directed IRA, or as it's abbreviated, an SDIRA, we can see on this slide that a regular IRA is relatively limited. You get stocks, bonds, mutual funds, and annuities, whereas on the self-directed side, we've got what's only a partial list. We have clients that are investing in all sorts of novel investments. This is just a partial listing. And the first item listed is real estate rental property, which remains consistently the most popular application for self-directed retirement accounts, be it self-directed IRAs or checkbook 401ks. Real estate rental property has always topped the list of investments. But you can see here that there's a world of opportunity that's available within the self-directed space, and there is no reason from a tax perspective nor an investment perspective to restrict yourself to the regular IRA investments. Well, what kinds of accounts, tax sheltered accounts, can be self-directed? The tax code, there are multiple types of tax sheltered and tax deferred vehicles. We've got, broadly speaking, they fall into three categories. We've got the IRA category, qualified plans, and then we've got the miscellaneous. All of these can be self-directed. One thing that you'd note is not on this list are 529 plans. 529 plans cannot be self-directed into any asset that you choose. But anything else can be self-directed. And just a little insight on the IRA side. The SEP IRA is a kind of IRA that's sponsored by businesses, and it's a profit-sharing plan. Simple IRA is likewise a plan for businesses. Spousal IRAs is not truly an IRA type. It just refers to the fact that if one spouse has earned income, then even the non-earning spouse can make IRA contributions. On the qualified plan side, there's a long list here. Solo 401k, which would be the chief focus within the self-directed space, is not truly another type of plan from the tax code perspective, but being that it's only for business owners without employees, there's the ability to have lots of flexibility with no compliance burden and very low cost. So the most popular vehicles amongst these qualified plans for self-direction are solo 401ks and the various IRA accounts. To understand the nature of these vehicles and the evolution of the industry, it's helpful to have an overview of the industry and how the tax code relates to that. And this is a graphic depiction of the IRA industry. So at the top, we've got the Internal Revenue Code 408 and 408A. 408A refers to the Roth IRAs, and it's the tax code that creates these tax sheltered vehicles. Beneath that larger umbrella, we've got the brokerage custodians and self-directed IRA custodians. We can see they both fall under the same umbrella, the same tax code. On the bottom right of the screen, there's a box called a checkbook IRA. That's a unique investment structure that's only available within the self-directed space. In many instances, but not all, it's an advantageous structure that can bring down costs and further increase investment flexibility. It's not going to be the focus of tonight's presentation. Perhaps we'll gloss over it a bit later further down. Within the brokerage side, we're accustomed to getting free accounts. Whenever you go to Schwab, Fidelity, Vanguard, you don't have to pay to have an IRA. There are no fees associated with that. But the reason for that, just a little insight, makes that very obvious. The reason why there are no fees associated with that is because they're going to make money on your investments. Every time you purchase an asset, a mutual fund, either it's a mutual fund that they actually manage and they're getting management fees, they're getting kickback fees, or they may be getting various trading fees. So you get the account for free. You can easily transact. You can buy any mutual fund with a few clicks of a mouse, but you're going to be restricted. Great place, but does not allow total diversification, and they certainly will not allow you to invest in rental real estate from which they generate no income. To give you that flexibility would totally defeat their business model. Contrast that with the self-directed IRA space and self-directed IRA custodians. With self-directed IRA custodian, accounts are not free. There are going to be some fees associated with having those accounts, and that's to be expected, and that's reasonable because they're not going to be making any fees off your investments. When you purchase a tax lien, a real estate rental property, or you do some sort of private lending, private stock, there's no kickback fee to the self-directed IRA custodian for administering that investments. Therefore, they must charge some sort of asset-based or transactional fees. These fees vary greatly across the industry, but you get the unrestricted investing into nearly any asset that you would like. It's important to appreciate the structure of the industry, because some people have this reaction, they're surprised to get the fee, and it's important to point out that it's never really free. At Schwab or Fidelity or some brokerage account, it's not truly free, it's just that the fees are not visible to you. But somewhere in there, there are a range of fees. In the prior slide, there was a link to an SEC page where the Securities and Exchange Commission outlines just a few of the fees that account holders pay to brokerage houses. And again, here we encounter the self-directed checkbook IRA structure, which we touched upon in the prior slide. In some instances, this can be very advantageous. What this does conceptually, rather than have your self-directed IRA custodian purchase the real estate directly on your behalf, perhaps you're looking to do multiple deals, and having multiple assets with a single custodian can sometimes get to be a costly undertaking. With the checkbook structure, we have the IRA custodian invest directly into a special purpose business entity, essentially a private equity investment that's made by the self-directed IRA for your IRA. That private equity company is controlled by the IRA owner, who then directs that company to invest in all the various assets. So there's the potential for cost savings and greater flexibility, because the IRA custodian, that is the self-directed IRA custodian, is marginalized, and all the IRA funds are put in direct control of the IRA account owner. This slide just has an image of the structure graphically. Here we see we've got the self-directed IRA custodian in the center, which transfers funds to an IRA LLC, and the IRA LLC then invests within the various assets. Okay, so with the greater flexibility that we get with self-directed investing, we encounter some tax rules that we're not going to encounter when using traditional IRA. The key tax rule to be aware of are the prohibited transaction rules, which essentially says that certain disqualified persons cannot transact with an IRA or 401k. Disqualified persons, the chief disqualified person is the IRA owner and various relatives. So if the IRA owner is spouse, parents and grandparents, children, as well as spouses of children. As important as it is to know who is disqualified, it's important to know who's not. And as you can see, many related parties are not disqualified persons per the tax code. That's siblings, in-laws, nephews and nieces, friends, aunts and uncles are not disqualified persons. So we know that we cannot have a transaction between an IRA and a disqualified person. And we know who the disqualified persons are. What constitutes a transaction between disqualified parties and a self-directed retirement account? Well, what is a transaction? So this bullet listing, as you can see if you read them, it's fairly extensive. So anytime you or any of your disqualified persons are maybe a counterparty to a transaction in which your IRA is involved, you have to take a step back and make sure you're not running afoul of the prohibited transaction rules. The prohibited transaction rules, if they're violated, can result in very severe tax penalties. So you always want to be on the safe side and err on the side of caution. Anytime, avoid any transaction in which you or any other disqualified person are a counterparty to your IRA. So if your IRA is buying real estate, it can buy real estate on the open market. But if you have real estate that's cash flowing and you don't want, and it's already profitable and you're paying taxes on that, you cannot move that property into your IRA. Had your IRA bought the property in the first place, it would have remained tax sheltered. But once you own it, you cannot move it from title under your name into the IRA. As you can see, one of these is bolded, and that's the lending of money or other extension of credit prohibited transaction. And that's because in coming slides, we'd like to focus on some of the implications of taking a loan within your 401k or IRA, George is going to address it at greater length in various investment aspects. But from a tax code perspective, it's important to know that, as we see on the next slide, your IRA or checkbook 401k can take a loan. So if you've got $50,000 in your IRA and you'd like to buy an investment property that's valued, that costs $100,000, your IRA can take a loan to finance the rest of the deal. However, being that you may not loan money to your IRA, nor may you engage in any extension of credit to your IRA, the IRA account owner cannot personally guarantee the loan taken on by the IRA. Therefore, when IRAs borrow money to finance deals, they have to take what's called a non-recourse loan. And that means it's non-recourse to the IRA account owner. In the event of default, if you're not paying that loan, if you're not abiding by the terms, the lender cannot go after your personal assets. So this results in increased risk to the lender because they do not get any personal guarantee, and decreased risk to the borrower. It's decreased risk to the IRA owner because they do not provide a personal guarantee. They're not allowed to. That would be a prohibited transaction. But as the result of these increased risks to the borrower, to the lender, and decreased risk to the lender, non-recourse loans are not provided by the overwhelming majority of financial institutions, and that's part of SDIRA Wealth's offering, is the ability to help you tap into non-recourse loans. But it is normal to expect a higher interest rate and reserve requirement with these loans to protect the lender due to the increased risk. Another aspect of investing using financing within a retirement account can be what's known as UDFI tax. Perhaps some of you are aware of some of these acronyms: UBIT, UBTI, UDFI. These are tossed around, often used interchangeably. They certainly have distinct meanings within the tax code, but what we want to focus on tonight is the UDFI. But just for purposes of providing an overview, UBIT is the acronym for Unrelated Business Income Tax. That's the umbrella category, and that refers to the actual tax liability that can be incurred by an IRA if it generates UBTI or UDFI. UBTI and UDFI, unrelated business taxable income, and unrelated debt financed income, are the types of income that can be generated within an IRA that can be subject to the UBIT tax. UBTI, unrelated business taxable income, is incurred when an IRA invests directly in an active trade or business, which does not apply to rental real estate and the majority of investments that are available to self-directed accounts. But what can apply is UDFI, and that's unrelated debt financed income. This applies to profits and gains that are attributable to debt. So if you use that $50,000 for a down payment on a rental property and you finance the balance, the $50,000, using a non-recourse loan, there's a potential for tax liability within the IRA, and that's only taxable to the extent and in relation to the debt financed portion. So it's only to the extent that debt is used is there a taxable income. And you can see at the bottom here, there's a bolded bullet point: checkbook 401k does not generate UDFI from real estate acquisition indebtedness. I don't think we're going to have a whole lot of time to talk about checkbook 401ks, but those are an alternative vehicle that can be used by those that qualify to use tax sheltered accounts and invest in real estate. And within a checkbook 401k, this UDFI tax does not apply to real estate. So that is a great plus, a great benefit of using a 401k structure as opposed to an IRA-based structure. However, regardless whether it's 401k or IRA, the UDFI tax should not intimidate and should not be a reason not to pursue such investments. Of course, it can be a factor into your investment analysis, but it's not something that should deter you from diversifying into real estate using an IRA. And this is a simplified overview of the calculation of the UDFI tax. We're not going to get into that much into that right now, and I do want to pass the slides over to George momentarily. But to suffice it to say, the point is there are lots of deductions that are available against the UDFI tax that can mitigate that tax, and you only encounter the tax if you have a profitable investment. And the UBIT tax does not flow through your personal tax return. It is completely independent of your personal tax return, and it doesn't impact your personal tax liability. On this slide, we've got a diagram of the checkbook control solo 401k structure. As you can see, there's no custodian involved, or for those that want to use an LLC for checkbook control, there's no LLC involved here either. You have the 401k plan, this checkbook 401k plan. It gets a bank account. You can fund it with contributions and rollovers, and then invest directly in your various self-directed investments without having to deal with any third party. Who qualifies for checkbook solo 401k? It's a really powerful vehicle, so it's important to note who qualifies and who doesn't. The basic requirements for qualifying for a checkbook solo 401k is having income or having an active trade or business. So it's got to be an active trade or business. A very common question that we encounter is, I have income, rental income from real estate properties. Can I use that? Is that a business that can sponsor a 401k? And the answer is not. Rental real estate is an investment. It gets favorable tax treatment as an investment, and therefore cannot create a 401k plan. It has to be an active trade or business. The second key requirement is the absence of full-time employees. The moment there are full-time employees that are not business owners or their spouses, then you encounter more compliance burden, greater compliance burden, and oftentimes it's not worthwhile to maintain the total self-directed status of the checkbook 401k if there are other employees that are not owners involved. And in this slide, we've got an overview of just some of the pros, some of the benefits of the checkbook 401k vis-a-vis using an IRA-based structure. As we just said, no need for a third-party custodian whatsoever. IRAs must have a custodian. It's hardwired into the tax code. There are far higher contribution amounts. There's a lot of sophisticated tax strategy and advanced tax strategy that can be implemented within a checkbook 401k. So if you're looking for very high tax deductions or very high Roth contributions, you can have all those within a single plan. In addition, a 401k has a loan option. So although taking a loan from your IRA is a prohibited transaction, there is a carve out for solo 401k plans that allow plan participants to take a loan. So you can theoretically contribute money to a checkbook 401k and then turn around, pull it right out as a loan to be used for any purpose as you'd like. And then we've got the last one, which is the leveraged real estate investments, which do not have the UDFI tax, which is a great benefit of the checkbook 401ks. And I'd say with this, I'd like to hand it over to George. I certainly hope that you'll present me with any questions that you've got. Look forward to answering questions. You can reach out to me certainly after the webinar. We'll share contact info to address any questions that we're not able to address within the context of this presentation. And with this, I hand it over to George to tell you about the solution, the investment solution that he and his company have put together.
Great, thank you, Bernard. I really appreciate that, honestly. I hope everybody enjoyed that part of the presentation, going into some of the tax code and figuring out what types of IRAs might be right for different type of people as well. I think it's great to discuss these topics, as really there's not enough education out there on the type of self-directed plans that are right for specific situations and specific individuals. So I think that's amazing, to be able to talk about that and kind of go through the whole topic. So I appreciate that. And with that said, I'm going to talk a little bit more on the real estate focused end right now compared to the self-directed IRA side that we just went through. And I'm going to talk a little bit about SDIRA Wealth and who we are as a company, what we've done over the years for clients, as well as some of the solutions that we're able to offer individuals out there, especially within their self-directed plans. So first things first, we are headquartered in Chicago, Illinois, with a couple of other offices operationally across the country as well, mainly on the East Coast and the Southeast of the country. One thing that we are first to all of our clients and partners is an education company. For the last really over 30 years, we've provided services, but first and foremost, it's always been about education, educating our clients and partners and investors about what the possibilities are of retirement plans, how to set yourself up for the future, and really go beyond the status quo. That's a big part of our mission statement, is really helping people look at retirement as not really a way that it's always been done, but instead a solution that can be really taken to another level and really increase their wealth. So that's what we've come up with as the SDIRA Wealth Solution, which I'll be talking a little bit about. But a little bit about our history. Like I said, we've been about 30 years in experience. Real estate investments in over 16 states and 60 cities. We are a full service provider, so providing individuals with services in real estate that go from management to ongoing maintenance throughout all of our assets, as well as asset protection for our clients. What I want to get into is the self-directed wealth solution. It's something that we bring up a lot to our clients. From the beginning, it's something that's very important because it's all about the results, of a particular investment, and it's all about looking into the future and how you can be protected, especially within your retirement plan. So one of the main things that we look at when considering investments, of course, in your retirement account in real estate is protection. You want to be protected from market volatility. Real estate is a hedge against inflation, which is great because it's a natural hedge. So as inflation goes up, so do real estate values, so do rents as well. They're all very correlated. And some of the benefits that it has over stock market investments, such as stocks, bonds, and mutual funds, is that you have a hedge against inflation, but you're also protected from market volatility. Obviously, real estate markets are a very localized phenomenon. Each market across the country moves at its own pace. They're not all correlated. They all have their own separate local economies. So that is obviously something that's very important when investing, especially within your retirement plan into any kind of markets, is understanding the risks and getting protected that way. One thing that we do to help our clients is to accelerate their performance of their retirement plan by really helping them enjoy 3 streams of income, from cash flow to appreciation to principal reduction on your equity. Real estate offers you really a 3 versus 1 in terms of types of revenue streams. And that's one thing that's been talked about for many years right now. And really over the last 10 years, self-directed IRAs have gained a huge prominence in the country. One is because of the recession and how the stock market took a big hit, but also people wanted more control, wanted to take control back and be able to make all of those investment decisions for themselves, instead of relying on the stock market, which could go up and down and you can lose 30–40% of your portfolio just like that without really understanding why or knowing what happened. So one thing that real estate creates is full control in the investment, especially within self-directed IRAs, which is really the basis for so many individuals in terms of why they set up a self-directed account. Is you want that control, you want to be able to make all the investment decisions, and you also want to have a big array of alternative investments out there to look at instead of just securities-based investments. And then finally, part of our self-directed wealth solution is transparency. There are no hidden fees within our investment model for clients, so it's very straightforward. You have an idea of exactly what you're able to create and exactly what type of expenses you're able to see in an investment like this. So it's huge because obviously there's a lot of mistrust in the stock market industry these days with where fees are going, where all the hidden fees out there are. So it's a big thing. This slide shows a little bit about some of the recent, in the last couple of years, investment locations SDIRA Wealth has been in and has helped our clients cultivate new investments in real estate through. And as you know, this is a full service solution. So I'll talk a little bit about some of the different models for success in the upcoming slides. But overall, we are one of the largest bulk buyers of real estate in the country. We basically support that by having our properties pre-screened, qualified tenants in place, and that translates to immediate cash flow from day one for our clients. And I'll also be talking about non-recourse financing, as Bernard touched upon in the previous slides, and how that can help leverage your retirement plan to be able to maximize really your purchasing power. So our models for success really revolve around four things, being your evaluator, your management team, your partner, and your financing. So to start off on the first one, your evaluator means we're evaluating markets all over the country, doing the necessary due diligence on the front end to help our clients get into locations and markets across the country that make sense today. Markets that have potential, markets that are right now buyers markets booming, not an area where you're buying at the most inflated price, and more likely than not, you're going to go down from there. So that's one thing for our clients. The second is management. We actually offer a full service in management for our clients, having a double layer service from on-site management to an in-house team, helping every single one of our clients really make the investment as passive as possible while making your money work for you in your retirement account, compared to actually being a landlord and having to deal with all of those duties. And third of all, your partner in the investment. One thing that's very difficult in real estate is to have a partner on your back, somebody that's always going to be there to help you from the beginning to the end of your investments. And that's one thing that over the last so many years now, we've worked with all of our clients to help them grow their portfolios, help them get into the right situations, put them in good places where they're able to grow their portfolio by leveraging, by adding the right types. And then finally, the financing portion, as I mentioned, utilizing non-recourse financing to leverage your dollars, be able to maximize your purchasing power. And it offers you a return that you might not see, otherwise. And one of the biggest things in real estate over the years has always been utilizing leverage and utilizing financing so that you can buy more for less. And this slide talks a little bit about non-recourse financing and what it is. I know we touched on it just a bit, but just to expand on the topic, essentially it is asset-based lending, the only allowable form of financing within your self-directed IRA or solo 401k plan. It's a financing that isn't as accessible out there as conventional loans might be. I know everybody might be familiar with conventional financing if you've purchased a primary residence before, or if you've purchased investment properties. In many cases outside of your retirement account, you would have used conventional financing. Now, the difference with this loan is that these are performance-based loans, still offered by third-party banks and lenders. Instead, they're more so looking at the performance of the asset compared to who you are as a borrower. And if you pass on credit, if you have good income, low debt, your tax returns look good, they don't look at those things. Non-recourse lenders look at the performance of the asset, such as rent rolls. They look at cash flow, occupancy rates, market condition of the asset to make sure that it is collateral that makes sense and that is not risky for that lender to be able to lend on. And some of the big advantages and why people use, of course, non-recourse is obviously leveraging your money means you're putting less money into the deal, meaning you're able to generate a higher cash-on-cash return overall because you've added less of your own capital and you're using someone else's funds to be able to purchase something. Higher appreciation rates because you're able to purchase multiple assets, in a given market compared to one. So, for example, if a property is $150,000 and you pay for that in cash, you've got only one property. If you spread that out across three, you're able to acquire three separate appreciating assets, which we will be covering on this slide here. This is a very important slide to understand the dynamic of non-recourse financing. I want everybody to take a look at the left side first, the left column, the all cash. So what this analyzes is an all cash purchase of a real estate property. And what we've used here is a single family home with the purchase price of $150,000. And on the right column, it's utilizing the same amount of money, $150,000 a month invested, but you're able to buy 3 properties with non-recourse financing inside of your self-directed IRA. So looking at the left column, you'll see, and these are example figures. So on the top, your purchase price is $150,000. That's how much you've invested. So it's an all cash purchase, no mortgage in place. So your rent, $1,300, property taxes of $200, insurance of $400, a management expense of 8%, giving you $100, and a monthly maintenance reserve for $40, giving you a monthly net cash flow of $920, which is just over $11,000 annually, and that translates to a 7.4% cash on cash return based on how much you invested, which is $150,000. So not too bad, 7.4. Now, if you look at the right side, with this one, you're investing the same amount of money, $150,000. Instead, you're buying $450,000 worth of real estate because you are financing the other $300,000 of that. So it gives you $450,000 value portfolio already. And basically the numbers on the right side are tripled now. Now you've got 3 properties, so rental income of $3,900 total monthly, and skipping down, monthly net of $1,110, which is roughly almost $200 more in monthly net income, and about $13,000 and $320 annual, over $2,000 more in net income, giving you a 12% cash on cash return. And one of the big numbers as well is you're reducing principal every year because you financed and your tenant is paying your mortgage. So you're adding in additional equity every single year. And this is not even counting any type of potential appreciation. You know, if these assets are in a strong growing market right now, each one of those 3 could appreciate, you know, anywhere from 3 to 5% per year conservatively, and have a huge equity position over the next 5 to 10 years compared to that one property that you have. Yes, you have no mortgage on it, but you only have one property and your portfolio is worth $150,000. When you pay off this portfolio of 3 properties on the right, your portfolio is worth $450,000 when they're paid off. So huge advantages there. Wanted to point that out. Some of the markets that we focus on as an investment firm, really 3 types primarily where we found the most success across the country. Emerging markets, which means areas that are prone to growth, areas that are going through different market cycle changes where they haven't really turned that corner just yet. So there's a lot of potential. College towns has been big for us. These are markets that are not really subject to the general economy in the US. They're more so, you know, localized, but can offer great returns and high demand for rent, of course. And then urban markets, you know, large cities that have diverse economies, which are able to offer investors, you know, safety in that market. And market cycles are very important to keep in mind when investing in real estate. You know, these days, of course, you know, you've heard of so many of the big markets out there, Los Angeles, Dallas, Miami, you know, just to name a few, where, you know, they've been in the news for many years right now. You know, you've seen reports on how overvalued they are, or how inflated or how expensive it's become to own real estate there, or how tough it is to cash flow. You know, these are markets that are, you know, essentially closer to that excitement and euphoria phase in the market cycle, where it's, you know, it's up there. Obviously, no one can predict a market cycle movement, of course, but, you know, through various research and due diligence on areas, you know, there's determinations to make when assessing cap rates and cash flow. Obviously, where we like to invest in is at that minimum opportunity risk point of despondency and panic, you know, in a market where people are afraid, a market where there is high supply. Supply and demand is such a huge aspect of investing in markets, you know, understanding how much inventory is left in the market and where demand is coming from and what demand looks like over the next couple of years. A quote that we always kind of encounter out here and mention is a quote by Warren Buffett, be aggressive when others are fearful. It's an amazing quote because really some of the most successful real estate investors in the country and investors in general have always taken advantage of those points in a market cycle where there's really a huge opportunity to get in there and get in at a low price. You know, like they always say, buy low, sell high. So this is a quote that, you know, we look at when we're investing in real estate markets out there to determine, like, is this the right place right now? You know, is this a market that we want to be aggressive in right now based on where demand is and how supply looks? And some of the main indicators that are looked at when determining these things, when you're investing all over the country, I mean, there's so many options out there, of course, and you've really got to figure out what are some of the main indicators you want to look for so you can narrow that list down to markets that make sense today, you know, not markets that made sense yesterday, of course. So building permits has always been a big one. You know, it helps you assess how much new development is happening and when that will be completed over the next couple of years. It gives you kind of a futuristic look as to where that market can go over the next 2, 3, 4, 5 years. Obviously, understanding the market cycles is very important. Absorption rates and available property. The cost of living in certain areas is very, very important because you're able to get into inventory and property that that can get in at lower prices, and that can translate to higher cash flow. That can translate to much more of a longer term potential as well. So these are some of the other main things that we look at. Employers are huge, wages are huge in an area, you know, rental growth, job growth year over year. These are all big things that, you know, you want to keep in mind of, you know, when looking into real estate markets, especially if your local market is too expensive or it just doesn't make sense to buy real estate rentals. And next couple slides here, just a couple of case studies, just to go over quickly of some real estate portfolios that our company has completed over the last couple of years, just to show people what you know, the potential of real estate is, even if you don't sell. This is a longer term approach that we take with so many of our clients. So many of them are looking at really that long-term cash flow potential that can be had with real estate. So the equity is just something like a cherry on top is what most people look at it like. But this is a portfolio out on the Atlantic coast of Florida, Fort Pierce, Florida, where, you know, over 6 years ago we had invested in a portfolio of multifamily and single family homes. And this is just one example of an individual single that, you know, went from 99,000 back in 2012, and these days these properties are worth well over 140,000, adding about 40% in growth in that period, not counting any of the cash flow as well that has been accumulated during that point. Another example out in Naples on the Gulf Coast as well of Florida, where, you know, property prices have gone up tremendously over the last couple of years. So you've seen about a 63% increase just in the last 6 years, also not accounting for any cash flow on that. And this is actually a community out in Fort Myers, Florida, a community of townhomes and condos and a few single family homes that has really seen a tremendous value add over the last 6 years of 60% value growth, and averaged anywhere from about a 10 to a 12% cash flow return in that time. So investors have easily doubled their money, if some tripled, you know, within that time frame, just by getting into these markets at the right time. Some of the most recent locations where, you know, we've invested in as well has been out in Texas. Lubbock, Texas, on the western part of the state has been huge for development, has been huge for job growth. It's one of the more up and coming locations that really in the next 3 to 5 years is going to gain a lot of prominence. These are the type of markets that we as an investment firm look at, markets that are not at that tipping point yet, markets that are much lower in that market cycle phase. It just helps, you know, helps our clients on the equity end, it helps them on the cash flow end, just overall performance. And these are a couple pictures of some of the single family homes in that area. Obviously big, beautiful, you know, large developments out there. A couple of things that everybody can also catch up with us after the presentation is through our website, SDIRAwealth.com. We're going to have that up at the end here, but what you're able to see on that is testimonials, testimonial slides, you know, client testimonials from videos to written ones. We do have ebooks as well. We have quite a big selection of ebooks archived, from what your broker isn't telling you to prohibited transactions in self-directed IRAs. Really, as I mentioned, you want to get educated first on what you can and can't do, the differences between accounts, some of the real estate investments available to you, and really at that point determine what makes sense. And just to wrap up the webinar here, this is my contact information as well. So for everybody after the webinar here, definitely feel free to email us, call us as well. You can schedule appointments on the website at sdirawealth.com. That way you're going to be able to set up a phone call, review your portfolio. You can be able to take a look at, what investments might make sense for you, as well as us and Bernard helping you establish, the right type of self-directed plan if you don't already have one. So it's a great thing. And I'm going to pass it over to Bernard real quick for questions at the end of the webinar here.
Okay. I'm glad, appreciate all that information. That's a whole lot of information about real estate in general, and the SDIRA wealth solution in particular. On the investment side, having the flexibility to get into alternative assets can sometimes require more effort, and it's great that SDIRA Wealth has put together a way to get into these asset classes in a way that's passive. My focus in this space is on the tax structuring and tax setup, be it the checkbook 401k side or checkbook IRA. In those instances where it is advisable and beneficial, we set those up. We advise on prohibited transactions, on UBIT taxation, of course, can assist with any tax filings. I welcome any questions, and they can be sent to my direct email address, which is on the screen now, bernard@resurefinancial.com. And please check out our website, 401kcheckbook.com, 401kcheckbook.com. There's comprehensive info on the various structures, the compliance perspective, as well as an introduction to various asset classes that can be pursued within 401ks. With regard to some questions that we've gotten, some of those relate to UBIT and UDFI, and so I'm gonna, without getting too technical, I'm just gonna provide a brief summary of how that works to remove any of the confusion. The process with the UBIT tax return is actually a tax return that's filed by the IRA custodian when applicable, and if it's applicable within a 401k, it's filed on behalf of the 401k plan by the administrator or trustee. It's not something that's filed together with the personal return with the 1040 of the account owner, or if it's a 401k that's sponsored by a business, and that business may have a business tax return at 1065, 1120, or 1120S. The UBIT tax return is completely independent of that, and it has no implication on the personal tax liability. Furthermore, there's no double taxation. There's the UBIT and the UDFI taxes are structured in a way so that you'll never get hit with both UBTI and UDFI. Only one of them would apply, if any. Within the UBTI space, that's for the active trader business. That's most commonly encountered if you're doing real estate flipping inside of an IRA or 401k. There's no exemption for the UBTI, that's for the trader business income for a 401k. So engaging in lots of real estate flips within one of these accounts can potentially generate the unrelated business taxable income for engaging in an active trader business. How many flips is considered regularly engaging in a trader business is anybody's guess. There's really no clear guidance. You can be conservative, you can be aggressive. There really is, it's not in the tax code, it's a facts and circumstances, and people take different approaches to it. And I think that addresses the questions regarding UBIT, UDFI from a high level, and I hope that clarifies some of the questions that required responding to.
Well, thank you, everybody. Appreciate that, Bernard. Thank you for your time, and thank you, everybody, for joining the webinar. We look forward to connecting with each one of you. Please let us know if you do have any questions. Please email us after the presentation. You may also give us a phone call at the numbers provided. Thank you again.
Thanks all. Thanks, George.